structural reset could start to reprice silver. That's what I'm seeing. $75, $100. And I say that to you, and that's not pie in the sky, because if you take the 45-year cup and handle that goes like this, the way technical analysis works is the top of the cup 1980, the bottom of the cup the early 90s, and again back up to 2011 again, which is near the top of the cup, and then formed another. It's a double cup and handle, but the way that it works is once silver.
The global precious metals market may be approaching a turning point. In this video, Andy Schectman shares two major insights. First, how silver could enter a new price era once physical demand outweighs paper trading. And second, how gold may be quietly preparing for a revaluation within the global monetary system. We'll look closely at both perspectives and what they could mean for the future of silver and gold prices.
Yeah, absolutely. The short-term implication would be liquidations and survival-driven selling can trigger volatility. That's the short term. Even sharp pullbacks. Medium term, as far as I'm concerned, is that once this forced selling ends, the physical scarcity starts to dominate. And silver sustains its higher prices, $50 plus. But long term, if confidence in this paper system collapses, like we're seeing, a structural reset could start to reprice silver. That's what I'm seeing. $75, $100. And I say that to you, and that's not pie in the sky, because if you take the 45-year cup and handle that goes like this, the way technical analysis works is the top of the cup 1980, the bottom of the cup the early 90s, and again back up to 2011 again, which is near the top of the cup, and then formed another. It's a double cup and handle, but the way that it works is once silver has broken through 50, which it has, technical analysis would say you take the distance from the bottom of the top, which was $46, from 50 to 4, and you add it to the top. That would mean that the next target from a technical analysis standpoint is $96. And I think that's exactly what you will begin to see, where the market physically begins to exert itself over the paper shenanigans that we've seen for a long, long time.
What Andy Schectman is describing here is a deep look into how different phases of the market play out, from short-term volatility to long-term structural change. He explains that during uncertain times, we often see forced liquidations, investors selling not by choice, but by necessity. This creates temporary market turbulence and price swings. However, when that stage ends, the underlying fundamentals begin to reassert themselves. In silver's case, that fundamental is physical scarcity. Once the paper-driven selling is absorbed, real-world supply and demand start guiding the price again. Andy then refers to long-term technical analysis showing a potential target near $96 per ounce if silver breaks through its key historical resistance around $50. This projection isn't based on speculation, but on a well-known chart formation called the double cup and handle, which tracks price movements over multiple decades. The key takeaway from this discussion is that short-term volatility doesn't necessarily reflect silver's true value. Once the market transitions from paper trading to physical demand, prices could begin reflecting real scarcity and long-term fundamentals.
What I said was it's not time to trade your silver for gold yet. There will come a time to do it when the ratio corrects. It's an anomaly where the ratio is. For 5,000 years, the ratio was 16 to 1.
Right.
It's coming out of the ground at 7 to 1. There will come a time to trade your silver into gold. But yeah, I wouldn't. Look, I think gold's going to go higher than anyone thinks possible. It is being reintegrated into the monetary system 100%. So, to put all your money into silver, if you're buying precious metals, it is a better value, and it does have an angle. I still think I wouldn't ignore gold. And even though it's gone up, high, I think it's going to go much higher. Not straight up, but I really do think it'll go higher than people think. If Judy is right, and if I'm right, and they're going to peg it to the back end of the Treasury market, it has to be much, much higher. Luke Roman says they'll let it go to 7 or 8,000, and then they'll revalue it from a higher level, so as to not have to revalue it from such a low level. Luke Roman is as smart as they get, so I wouldn't discount what he says either.
Okay, thanks. All right.
In this part, Andy shifts his focus from silver to gold, highlighting the relationship between the two metals and how timing matters for long-term investors. He notes that it's not yet the time to trade silver for gold, mainly because the gold to silver ratio remains historically unbalanced. For thousands of years, the ratio averaged at around 16 to 1, meaning it took roughly 16 ounces of silver to equal 1 ounce of gold. Today, that ratio is much higher, while silver is being mined at about 7 to 1, showing that silver may still be undervalued relative to gold. Andy also points out that gold's role in the financial system appears to be evolving. He believes it is being gradually reintegrated into the global monetary framework, possibly as a stabilizing asset for future fiscal policies. Analysts like Luke Groman have suggested that gold could rise significantly in value, even to levels such as $7,000 or $8,000 per ounce, before being officially revalued to support a more balanced system. This discussion isn't about short-term trading, but about understanding how both metals fit into a broader shift in global finance. Silver continues to offer strong relative value, while gold's long-term position as a monetary anchor may soon be reaffirmed. This commentary is for educational and informational purposes only. It is based on publicly available market analysis and expert discussions. Nothing in this video constitutes financial or investment advice. Always do your own research before making financial decisions.